Okay, great. Thank you. How are you, everybody? Thanks for coming today. We're going to talk about student loan repayments. So this session is really geared towards students who are seniors in college and they're graduating and about to go into loan repayment, or maybe they're in their grace period and about to go into loan repayment, and making sure that we have all your bases covered. So we have a lot to cover today. So I'm going to try and keep things moving, but feel free to type your questions in the Q&A. And my colleague, Jonathan Hughes, is also on the line. So he is going to let us know if there are questions that he thinks everybody can benefit from. He'll give us a shout out and we'll do that live. So my name is Stephanie Wells. I've been at MEFA for over 20 years, been working in higher ed financing for over 27 years. So it's been a while. I've helped thousands of families and students through the whole college enrollment process. And right now I work directly with colleges and helping them with their students to help pay the bills. But we do a lot of great work at MEFA. And, I'm thrilled to be here today to be able to hopefully offer a little bit of guidance and some solutions and maybe give yourself a little bit of a stress relief that, you got this covered and we're going to help you. And so today we're going to talk about student loan repayment. But beyond today, MEFA is still here. We have lots of resources at MEFA to help you. We have blogs, videos, podcasts, social media content. So feel free to, digest it in any way that you need. We have an email and phone number I'll leave you with at the end if you need to call us or email us for anything. We're here to help. And of course, everything we do at MEFA is free of charge, as always. So we do have the chat turned off today, so feel free to type those questions in the Q&A. A little bit about MEFA and who we are. We are a nonprofit quasi-state authority. We've been around since 1982, helping families with saving and planning and paying for college. We do have products such as savings plans and loan programs and education refinancing loans. But the biggest thing we do here at MEFA is offer guidance and education for families. So that is, a critical piece of our nonprofit mission. So here's a few of the things we're going to talk about today. Really what we want you to digest is just to know the options that are available, to know that if that payment amount for your first bill is way higher than you can afford, what are your options? What kind of forgiveness programs are out there? We are going to cover as much as possible today, but we also are going to leave you with websites and resources to go back and do some of your own homework. So I'm going to be giving you things to do as we go. All right, so let's talk about the first steps here. So first things first, before we even look at your loan payments, you need to create a budget when you graduate. So if you're a college senior and you're about to graduate in May, congratulations, by the way, you definitely want to create some sort of monthly budget. Even if it's just a part-time job that you have when you just get out of school until you go through those interviews and get a full-time job, you need to have some sort of budget so that you can manage your expenses. And, a lot of times when students are graduating, they get their first job out of school, and that salary might seem like a really big amount because you're going from maybe working part-time to having a full-time job. But, when you start taking into account taxes and medical bills and, insurance and, money towards retirement and a car payment and a, rent payment, things like that, it eats up your salary pretty quick. So it's a good idea to create a budget. Now we have a sample little chart here. We have this on our website, so you can find it there. But there's so many great options out there for online apps that you can use, and many of them are free. You might not get all the full bells and whistles unless you pay for it, but if you want to just do a budget app on your phone, those can be pretty fun and handy too. But regardless, create a budget in some way, shape, or form. So you want to identify all your bills and expenses. So everything down to the dog food for your pet and dog sitting, if you need that when you start going to work full time, to, like I said, your insurance and taxes that are taking it out of your paycheck, money that's taken out for your retirement. You want to get started on retirement as soon as possible. So once you get your first full-time job, so you definitely want to, distinguish what you have to pay every month. And then there's things that you want to use your money for, such as entertainment, the Netflix subscriptions and Hulu and all those good things. Those all add up. Those are wants, not needs. So we might need to see all those great shows on Netflix, but if it's going to put you over your budget, then maybe that's an area to scale back. Or, you can really just look at what you're spending your money on. What I've done in the past when we're trying to get a handle on my budget is I just keep track just for a month, every single penny I spent and put it in categories. So I spent this amount at CVS and this amount on, gas and rent and or mortgage or whatever it might be, just to see, where is my money going? Because it goes out pretty quick, goes out of your wallet pretty quick. And sometimes you don't even know where it went. And then you can decide, okay, with my wants, what do I want to spend my money on? Do I have to have my Netflix account? Yes. But maybe I don't need to go out to dinner 3 times a week, maybe 2. So little things like that you can do just to manage your expenses. And if you're not doing this, then you might start looking at your credit cards to pay for things because you don't have enough money in your bank account. And that's when you might start racking up some bad consumer debt or expensive debt. So that's really important to establish a budget. You also want to take stock, and it's good to do this after you graduate over the summer. For most of your loans, if they're in deferment, they're not going to be due for 6 months until November. Most students have a 6-month grace period. So it is important to just know, what do you have? What is your debt amount for each of the loans that you have? Do you have just federal student loans, or did you co-sign for a loan with mom and dad, for example? It might be a private loan, maybe even a MEFA loan. So you might have, different loan servicers and different loan amounts at different interest rates. So you really want to find out, where is my debt at and who's servicing those loans. So you'll find out, you will get mail and email from your loan servicers, and you should already know who they are because they should be reaching out to you. So that you know what website to go to, what phone number to call, download their app. If they have an app, most loan servicers have really great apps that you can use just to keep yourself on track and knowing, what your debt levels are, when your payments are going to be due, all of that good stuff. So on studentaid.ed.gov, the website's right here. You can see it on the screen. That's where you can find out all of your federal loan information. If you have a private loan through a bank or MEFA or somebody like that, it's not going to be on this website because they're not federal loans, but you can find out all of your federal loans by logging into studentaid.gov. And you should be able to find your loan servicer there who can tell you when your first payment is due and what that payment amount will be. And that should be on your loan servicer account as well online. If you do have loans above and beyond your federal direct student loans, like I mentioned, a private loan, alternative loan, you don't know who you borrowed through or where the money is, you can check with your financial aid office. They certify those loans, so they should know where you borrowed through and provide you with a phone number or website to get in touch with your private loan servicer. But they will be reaching out to you as well. Now, if you did co-sign for a loan with mom and dad, if mom or dad is the primary borrower on the loan, the emails and the mail might be going to them. So you might want to check in with them as well. But just check on their website, download the app, just know what your payments are and how much, when they're due. That's important so that you can start, making sure you can incorporate those monthly payments, even though they might not be due for 6 months. You want to make sure that you have room in your budget for those student loan payments when they come due. That's really, really important to do at this time of year. If you're, busy with finals, getting through the last month or 2 of school, it can wait till May, it can wait till after graduation, but right thereafter, you want to get moving on this. So once you've established where your money is at, how much you owe and where you're going to be making your payments through, you do want to establish an online account with your loan servicer. If you haven't already done that, you may have already done that. And if they have an app, the apps, of course, are very handy. You can easily just make a quick payment if you realize, oh, geez, I forgot my payment was due. in a couple days and I don't have time to mail a check or whatnot, you can just go online and make your payment there. But like I said, just add that monthly payment into your budget so that it's there. Even if you're right now building in those student loan payments into your budget, maybe put that money into a savings account. So you're still paying that money every month, but instead of paying the student loan for 6 months, you're putting money away in a savings account. So it's part of your budget. That's a good way to, create a budget with your monthly loan payments. And make a note, give yourself a little note on your phone, an alert, maybe a month ahead of when those payments are going to be coming due. And just for folks who are just logging in now, just want to let you know that we are recording today's session. We'll share it with everybody, as well as a link to the slides. So everything that's on here, you'll get a copy of. Okay, so federal student loans have lots of repayment options. You are going to be assigned the standard 10-year repayment term right out of the box. So everybody is going to have a standard 10-year repayment term when they graduate with their federal direct student loans. Now you can extend that, and I'm going to go through a laundry list of federal student loan repayment options if that monthly payment is too high and you can't fit it in your monthly budget. So if you need to, lower your monthly payment, that's going to cost you more over the long term because you're going to be taking longer to pay that loan off, more interest will accrue, but it's better to have an affordable monthly payment that you can manage and make sure your payments are on time. That's really the most critical piece. You can try this great tool through the federal department's website, the Student Loan Simulator. It's a great tool to play around with the different repayment options that are available for you. So again, I'll just click on it real quick for you. You can see it right here. This is what the website looks like. So you can do different things here. There's lots of great tools on the federal student loan website. So definitely check that out to play around with some numbers there. Now here is the laundry list I mentioned of federal student loan repayment options. So I'm not going to read every single one, out loud. I'll just kind of give you a high level overview. Like I mentioned, this 10-year standard term, if those payments are too steep, and you want to still pay it in 10 years, you could maybe do a graduated repayment option where you're still paying off in 10 years, but you start maybe 3 years at a lower payment, goes up another 3 years at a higher payment, and then the last 3 or 4 years are a bigger, balloon payment. So you're starting at a lower payment and going up as you hopefully earn money in a salary at your new employer. And then we have extended repayment options that can go beyond that 10 years. And then there's lots of different repayment options that are based on your income. So you can see them all here and go on the federalstudentaid.gov, studentaid.ed.gov website to see more details, but they're all right here. Some of them require 10% of your income. And these income-based repayment options can be really great for students who are going into a field that maybe they don't start out with a great, really high starting salary. So that's what these repayment options are built for, to accommodate students, budgets and salaries based on, where they are in life, for example. And repayment options can go anywhere from 10 to 25 years, depending on your income and the repayment option you choose. So that student loan simulator can really be helpful. Now, here's an example. Rather than going through all the different repayment options, we thought it would be good to show you an example of a student. So here's Victoria. She has $40,000 in federal direct student loans. $20,000 unsubsidized, meaning interest was accruing while she was in school, and $20,000 is subsidized, meaning interest was not accruing, but now that she's about to graduate, interest will start accruing at a rate of 5.5%. Now, this is just an example. The rates right now for these loans are 3.73% for the loans for folks who took out loans this year. So she has a job, income of $45,000, single, lives here in Massachusetts, and if she's lucky, her income is going to increase at a rate of 5% a year. if she's lucky. You know, most people, you know, they're looking at 3%, maybe even less, maybe more. But just for today's example, you can see for that $40,000 loan, that initial 10-year loan that everybody is set up with, that is a pretty high payment of $434 to start with. But you can see if you look at the total interest paid for all of these repayment options, that 10-year loan is going to be the most cost effective, even though it has the highest payment out of the box. So if you can afford that 10-year repayment, then go for that. It's going to save you interest over the long term. But you can see as we go, we have different initial payments and final payments for some of those graduated or income-based repayment options. They do go up, but you can see the amount of interest you're being charged also goes up along with them because you're taking longer to pay off that loan. So repayment plan summary, just some of the options here. And again, my colleague Jonathan is behind the scenes, hopefully answering some of those Q&As for us. We do have income-based repayment options for you. So some might be 20% of your discretionary income with a 12-year repayment, could be 15%. It really depends on the type of program you're in. And if you do qualify for multiple income-based repayment options, borrowers are always going to pay the lesser of those. So that's for your federal student loans. Now, if you do have private loans, such as a loan through MEFA, for example, you want to make sure that you're managing those payments as well. So make sure, just like with your federal student loans, that you know who the lender is, who the loan servicer websites are. Make sure you have copies of your billing statements. If you defer these private loans, usually there's a 6-month grace period after you graduate, just like with the federal direct student loans. But private loans are not federal loans. They don't have all those multiple repayment options. They don't have necessarily forgiveness options like the federal direct student loans do. Right now with federal student loans, the income is the interest is frozen and payments are voluntary right now because of the pandemic. With your private loans, you're probably not going to have as much flexibility with deferment and not making payments or extending them. But with that said, it doesn't mean you should definitely be in touch with your loan servicer on your private loans if you know that payment isn't going to be sustainable, if you need to modify your payments, you know, let's say you're out of work or something like that. It's always better to work with your loan servicer to find a good solution than to just ignore the payment and not pay them. So we're going to talk about the ramifications if you don't make your payments in a little bit. But private loans in general do have less repayment options and less flexibility and deferment. But that doesn't mean that you can't get any relief if you are working with a private lender. Now, a lot of private lenders, and I'll just use MEFA for example, may have a loan servicer that they contract with that services the loans for them. So if you have a MEFA loan, for example, MEFA is still the lender. We don't sell our loans, but we do hire AES or American Education Services to service those loans for us. So that's where you might have a loan servicer for your federal student loans, and then you might have a different servicer for your private loans. So you might have loans in 2 places. And so you definitely want to know who those organizations are and how to get in touch with them. So let's talk about loan repayment, some tips here. So it's good, as I mentioned, gathering your information and also determining your interest rate on each of the loans. So that should be on your loan servicer account, and just knowing, you know, what the total is. So when you start making your payments, it's really critical and important to make sure you're making your payments on time. And when I say on time, I mean the day it's due. If you do auto debit, you know, ACH, automatic debit out of your checking account every month, you're automatically, as long as you have money in your checking account, enough money there, you're going to be on time with your payments. So I definitely recommend using auto debit for everything as much as possible, but especially your student loans, because we're going to talk in a minute about some benefits that require on-time payment incentives. that you might want to take advantage of. If you have extra money that you want to put towards your loan, you can do that. There shouldn't be any repayment penalties for paying it off sooner or making larger payments. It's always a good thing to do. And you always want to repay your highest interest rate loan first. So you might have, let's say, $40,000 in the federal direct student loans, but then another, maybe say $10,000 on a private loan with a higher interest rate. Pay off that private loan first if you can make higher payments. Pay off your credit cards first if you can make payments on that, because they're going to have typically higher interest rates. So you want to tackle the debt with higher interest rates first if you can pay extra every month. And then if your family or yourself has a 529 college savings account and you have a little bit extra in that account after the student graduates, there is a great program where you can take out up to $10,000 to pay off a student loan. So that's a new option that just came about in the last year or two. So you can do that as well if you do have money in a saving 529. But it's a one-time up to $10,000 you can take out without penalty to pay down a student loan. So one quick question we have here, and just make sure, folks, that you put the questions in the Q&A versus the chat so that we can keep track there. So it's important to maintain good credit. In order to do that, you got to pay your bills on time, and that means the day they're due, not 20 days after they're due. That's not considered an on-time payment. Typically, anything that's paid after 30 days is going to show up as a red mark or black mark on your credit report. So just be cautious of that. You do want to, this can help you build a really good credit report and a really good credit profile if you're making your payments on time. So hopefully, for most students, they're starting fresh, maybe limited, hopefully consumer credit card debt, but you do have your student loans. So this is a good opportunity to start making those payments on time and establishing good credit. Your credit score going forward is going to be tied to a lot of things. So it's going to directly affect interest rates that you receive on a car loan, on a mortgage. So the higher credit score, the lower your interest rate in most cases. Or it might also just increase your chance of approval. Employers look at credit scores. Landlords look at credit scores. They look at credit profiles to see, have you been paying your bills on time? So it's really important to make sure that you maintain a good credit profile. And it can really help, save you money over the long term. Now, if you're not making your payments on time, not just with your student loans, but credit cards or, car loan, whatever it might be, those late payments are going to stay on your credit report for a good 7 years and affect your credit score in a negative way. So you do want to be really careful about that. The higher your consumer debt, I'm talking about credit cards, revolving debt, the higher amount in those, that can also drag down a credit score. So, we're not necessarily going over everything about credit today, but you can check out your credit report at annualcreditreport.com. You can get a free credit report each year. And there's also, if you do have a credit card or Credit Karma, there's another website app, you can keep track of your credit score. And there's links to show you on Credit Karma, for example. That's the one I have on my phone, not promoting any at all. It shows me what my credit score is every day, and if it's going up or down, and what I can do to help improve my credit score. So that's really, can't say it enough. I'll probably say it about 100 more times today about your credit, but it does, really drive a lot of your choices going forward. So don't be afraid to contact your loan servicer if you have questions. If you can't make your payments on time, if you're struggling, it's better to just address it right away and see if they can help you with, even if it's a short-term modified payments for 6 months to get you over, that hump. But it's important to, not ignore the calls you might be getting looking for payment. Definitely reach out to your loan servicer. You can also, if you're under certain income limits, deduct the student loan interest from your taxes each year. So when you're doing your taxes or having someone do those for you, you should be getting an interest statement every year from your loan servicer that shows what you paid in interest, so you can plug that in when you're doing your taxes. Okay, so let's talk about forgiveness. Sometimes with certain students, depending on the program they're in, where they're working, what they're doing, they might qualify for forgiveness. So forgiveness is when all of your student loans, whatever debt you still have left over, is forgiven. Now, it typically occurs for two reasons. Something really good, making on-time payments and, working in a public service field, for example, or relief if, God forbid, something bad should happen. So death or disability of the student, for example. So those are two ways that loans can be forgiven. So let's focus on, the positive impacts here. So you can see we have a list here of some of the federal student loan forgiveness programs. One that many of you have heard of, it's been in the news a lot, is the public service loan forgiveness. I'm not going to go through all of these because we can see them on the federal department's website, but I'll go through a couple that are more common. So public service loan forgiveness is when after 10 years of making payments, as long as they're, it has to be 10 years, they don't have to be consecutive. You do have to be working in a qualified employer, government organization, nonprofit, other qualified nonprofits. So if you're, let's say, a police officer, or you're a teacher working in a low-income area, for example, you might qualify for public service loan forgiveness. So I mentioned earlier that the standard repayment is 10 years. So for public service loan forgiveness, you can't qualify until you've been making payments for 10 years. So if you are in a public service field and you think your employer might qualify, you might look at some of those extended repayment options so you can benefit from this. But only your federal direct student loans qualify, okay? And it's only qualifies for payments made after October 1st of 2007. Now, after 10 years of making payments, and it could be, you're working as a teacher for 5 years, maybe take a break for a year and go back to teaching for another 5 years. That 1 year in the middle where you weren't in that job doesn't count, but those other 5 years totaling 10 do count. So it doesn't have to be a consecutive 10 years of payments. It could be 5, 1, and 5, or something like that. We do have a great webinar coming up in May, so I encourage you to register for that, about public service loan forgiveness and some of the temporary relief changes that are allowing a lot more folks to qualify for public service loan forgiveness until October 31st of 2022. So this is directly tied to the pandemic, where, payments have been frozen for 2 years. Folks have not had to make payments. One of the benefits, the temporary benefits to this program, is that even if you haven't been making payments during the pandemic, those months still qualify towards those 10 years. So that's one thing. I'm not going to go through all of it because it's a whole other webinar on public service loan forgiveness that we have coming up. But that's, there's a lot of great options right now if you're someone who has been in repayment for 10 years or more. So you can find out, there's a public service loan forgiveness help tool. You have the website right here, and definitely, register for our webinar. So other types of forgiveness, a couple of them are listed here. Teacher loan forgiveness. If you have old Perkins loans, those could potentially be canceled or discharged. For teacher loan forgiveness, you have to be full-time for 5 consecutive years and teaching in a school or agency that's in a, for low-income families. So it's only your direct federal student loans that qualify, up to $17,500. If you have some old Perkins loans, those are no longer being originated, but some folks might have Perkins loan debt on their servicing account. You can look into that too. So some of the qualified positions that would qualify are listed here, but I definitely encourage you to just go on studentaid.gov. All of the fine print and detail is listed there. we just want to make you aware of some of these options so that you can look into them if you do qualify. So some other reasons where a loan might be discharged. So these are some of the not so great reasons for loan discharge. So if in case of total or permanent disability of the students, their loans can be discharged. Death of the student or borrower, of course, loans will be discharged, God forbid. If the school violated a law, so we have seen over the last few years a lot of for-profit schools that were essentially, using a blunt term, scamming students, not providing the right resources and education that they were touting. A lot of those students don't have to make loan payments back if they went to some schools that have settled a suit with the federal government. So if you're in that situation, I encourage you to look into that. And there's information right down here about student loan forgiveness, freestudentloanadvice.org. And then if a school closed while a student was enrolled, that might be an option. It really depends on the school closing and the details about that. So avoiding and recovering, if you do end up in delinquency or default, what happens next? How do you dig yourself out of that hole? So there are a couple ways to do that. And so there's deferment, and you can qualify for deferment or defer your loans before. You don't have to be late on a payment or really struggling to defer. If you're going to grad school, for example, you can automatically defer your loans. But look, deferment is when you're postponing payment of the loan. You have to meet certain eligibility requirements, such as being in school at least half time. That qualifies for deferment. You do have to submit a request to your loan servicer. And if you have subsidized loans, those are not going to accrue interest while you're in deferment. Now, forbearance is a type of deferment where you're not making payments for a certain period of time, but that's because there's a financial situation when you're struggling, you really can't make those payments. You're not necessarily in a situation that qualifies for deferment, for example. So you do have to, work with your loan servicer. Interest is going to accrue on those loans, even if you're in forbearance. But it's better, it is going to cost more if you forbear payments because you're not making principal and interest payments. So that's going to cost more, but it's better to do that to make sure that you're not going into delinquency or default, to keep your loans in good standing. It might cost a little bit more, but it's better to keep your credit in good standing and utilize these short-term resources if you're in financial difficulty. So here are some of the reasons for deferment or forbearance. With deferment, unemployment might be a reason, economic hardship, graduate fellowships, military, Peace Corps is one, while you're in school. If you're doing forbearance, so it doesn't necessarily mean that you're late on payments or anything, but if you're in a medical or dental internship or residency, so you're not qualifying for an in-school deferment, but you could do forbearance on those payments until you get out of your residency, for example. And there's a few others here, National Guard, other medical reasons, things like that. So delinquency and default, just what it actually is it? Delinquency begins the day after your payment due date if the payment is not made in full. Now, not every lender or organization is going to report you to a credit bureau after one day missed pay, if your payment is late for one day. Usually it's approximately 30 days, but you do want to get it in on the date it's due. Now, default occurs when you haven't made payments at all for 270 days. So you haven't made your full payment on the loans for 270 days. So that's a pretty long time to make no payments and not apply for deferment or forbearance. So that's just basically ignoring the phone calls and ignoring the payments. Loan servicers are definitely going to be reaching out to you to try and help you come up with a plan to prevent default, to help keep you out of delinquency and default. And So just keep that in mind. Don't ignore those phone calls. They're trying to help and, come up with a solution for you. So some of the consequences of default. Your loans that are in default and delinquent after a certain period of time are going to be reported to the credit bureaus, which is instantly going to make your credit score go down. This is one of the most drastic negative effects on a credit score is default or delinquency on any type of payments. For a loan, car loan, mortgage, whatever it might be, credit cards, things like that. If you are in default on your student loan, you can't borrow additional federal student loans until you get out of default. So if you want to go back to school, but your loans are in default, you can't borrow to go back to school unless you get out of default. Sometimes if a student is in default, the loans become due immediately, payable in full. So there's a lot of negative ramifications here. You could lose eligibility for some of the repayment plans that are out there for you, or deferment and forgiveness options, things like that. At some point, a lender is going to just send the loan to a collection agency. So basically, it's not even their loan anymore. And the collection agency isn't going to necessarily have as many resources and options for you to get out of default. You could have your wages and taxes garnished as well. So some of the options to get out of default are to pay the loan off in full, which is easier said than done, because if you could do that, you would have already been making the payments, right? So you could consolidate your loan after making 3 consecutive payments. You can work with your loan servicer on that. You can consolidate and agree to repay under an income-driven plan, or you could rehabilitate the loan by making 9 on-time payments in 10 consecutive months. So there are ways to get out of default. You just need to work with your loan servicer on the best option that's going to work for you. And then, if you did go into default, or if that happens, it is going to hurt your credit. But the longer you are away from that, negative impact, the 10 years later, it's going to have less of an impact if you continue to make payments on time. So, it does stay on your credit score for quite a long time, but the longer you are from that impact, the less it's going to, drive down your credit score, for example. So let's talk about loan consolidation and refinancing. Federal loan consolidation is when you're combining federal loans, multiple federal loans, into one new consolidation loan. So it's going to be a weighted average of all of those interest rates, are going to be consolidated. There's tools and calculators on studentaid.gov. You can play around with the numbers, see if it's worth it for you to consolidate, especially if those, averages of rates are being weighted. You might say, okay, well, I don't want to consolidate this loan because there's a really low rate and I want to keep that low rate, but I might consolidate my other 3 loans that have a higher rate, for example. There's several repayment plans available with the federal loan consolidation as well, 10 to 30 years. Sometimes federal loan consolidation can be great to extend repayment. A student cannot consolidate mom or dad's federal plus loan, however. A plus loan, which is a parent loan for undergraduate students, can only be consolidated by the parent who is on that loan. With federal loan consolidation, you can't add in your private loans into that. It can only be federal loans. Some of the things to consider, why it might be worth it, just for convenience, having one bill to deal with. But I will say that even if you have multiple loans with a loan servicer, everything's online now. If you do auto debit, it's really not a big deal to have multiple loans with a loan servicer. So you don't necessarily have to consolidate to make it easy to make your payments. You could lower your payments. That's a big reason why a lot of folks consolidate. And there could be different repayment plans, such as public service loan forgiveness, extending those repayments, for example. If you did borrow, let's say through a lender previously, when the federal loan programs were in order and banks were lending federal loans after 2009, those programs went away, but some of you may have, debt from 2007 or even earlier. through a federal loan lender. And you may have had borrower benefits such as on-time payment incentives. If you consolidate those loans, you will lose those borrower benefits because you're basically paying off all the old loans and consolidating into one new loan with new loan terms. Now, there's also education loan refinancing, which is a little bit different. That's done through a private lender. So I'm just going to use MEFA, for example. We have an education refinancing loan. With that loan, you can refinance your federal and private loans, or just private loans if you want to, or just federal loans if you want to. But just know, once you're paying off those loans with a finance refi loan, you're losing whatever benefits you had with that. So we've talked a lot about federal loan benefits today. So if you are looking at education loan refinancing, you really want to be cautious of whether you want to combine your federal loans with your private student loans that might have a higher interest rate. So you might you'll lose all those great federal loan benefits that we've been talking about today. So just to keep that in mind if you're looking at education loan refinancing. There could be fixed and variable rates. There's calculators on the lender websites that you can play with and run numbers before you even apply. But it can help you, strengthen your credit by making sure you're making those payments on time. By refinancing, it might allow you to reduce your overall monthly payments by locking in a lower rate. So there could be a lot of good benefits to it to make repayment easier, but just be cautious of refinancing your federal student loans with private loans because you will lose all those federal student loan benefits. Okay, so consolidation versus refinancing, just a couple of comparisons here. Federal loans are eligible for both. Private loans are only eligible if you do student loan refinancing through a private lender. Credit check is required on a student loan refinancing, but not on the direct student loan federal program. With direct student loan consolidation, it's a weighted average of interest rates, so you're not necessarily reducing your rate. With student loan refinancing, you may be able to lock in a lower rate. So you could save money on both, but you will get, that one bill for both, which is convenient. So some of the reasons why you might consider it, having that one bill, maybe locking in a lower rate. You might want to switch from a variable rate to a fixed rate or vice versa. And then you may be extending the length of repayment to lower that monthly payment. That is going to increase your total cost, but it might make the payments more affordable for you. So let's go through, I'm not going to go through all of these sites here, but here's some great resources for you. And again, we're going to email everybody registered today with these slides and a link to the recording. So you'll have these these websites here. MEFA.org, we do have that education refinancing loan I mentioned, but we have lots of great tools, resources, blogs, education information about how to manage your student loans on MEFA.org. So definitely check that out. Listen to our podcast, go on our social media channels. I'll show you where those are in a minute. I mentioned earlier, just looking at that federal student loan interest, irs.gov is a good website to go to. We talked all day or the past hour about studentaid.ed.gov, which is a great website. Everything you need to know about your federal student loans are there. And then some other, budgeting and credit monitoring websites as well. And here are our social media connections. So we invite you to log in, watch our videos, tweet us, and definitely follow along with our podcasts on social media. And with that, I am going to open it up for questions. So I know we have a few questions in there. But before we do that, I do want to thank everybody for joining us today. I hope this was helpful and empowers you to feel a little bit more comfortable that there's a lot of options when you start going into loan repayment. So our phone numbers here, our emails here, be in touch. All of the resources we have are free of charge. You can call us or email us at any time if you need assistance. So with that, I am going to touch base with my colleague, Jonathan. I just see one message in the chat of whether you can pay off subsidized loans before graduation. And the answer to that is yes, you can pay off any of your loans at any time. So feel free if you want to do that.
Hey, Stephanie. So I have a question for you here. Somebody wants to know, does it make sense to consolidate subsidized and unsubsidized loans together?
It can make sense to do that because after graduation, you're going to be charged interest on those subsidized loans. So once you graduate, once a student graduates, they're no longer subsidized, unless maybe they're going to grad school and continuing deferment. So in those cases, if you don't qualify for deferment and the loans are in repayment, the subsidized loans are now unsubsidized loans that are accruing interest. So it could make sense to consolidate them after the student graduates.
Thanks. Somebody also wants to know if we could explain a little bit more. Oh, before I do that, I'm sorry. Let me get to one. Somebody wanted to see where he logged in late and wanted to see where the student loan calculator or simulator is.
Okay, I'll show that while you're queuing up the next step.
Thank you. Thank you. And yes, I've been asked if we could explain student loan forgiveness more. No, that's a big topic.
Yeah,
it probably deserves its own and actually has its own webinar.
Its own webinar. Yeah. Let me just find the. Sorry, I'm trying to find the student loan simulator. Here you go. Okay, so you're going to get copies of these slides, everybody. So here is the studentaid.gov/loan-simulator. So you can check that out here. So you'll get a copy of these slides with this website there. And then forgiveness is also on this. Let me just get to those slides here. Sorry about the scrolling. Here we go. Okay. So here is what student loan forgiveness is. It's either a reward for doing something good or relief if, God forbid, something bad should happen. So again, like Jonathan was saying, there's lots of different options here, and you really should go on to studentaid.ed.gov to look at them in more detail. Some of the more common ones would be public service loan forgiveness, which we spent a lot of time talking about. So you can find all of that information on studentaid.ed.gov to get more details about all the different types of forgiveness. But it's basically different ways that whatever balance you have at that time is forgiven, and you don't have to pay back whatever balance you have left.
Okay, here's a good one. Someone wrote, my loan service provider said that when I go to grad school, my school will automatically let my loan provider know, and that loan will automatically go into deferment. But the presentation showed that you'd have to apply for it through your provider. So I wonder if you could explain just.
Yeah, that's good. Yeah, let me clarify that because that's a good question. So if you're deferring for in-school, so just in-school deferment, and this is really the only one that qualifies. Typically what happens is whatever school you go to, they're going to report to a national clearinghouse that you're in school. So that will automatically put your federal student loans into deferment. And you can continue to make voluntary payments if you want. So for in-school deferment, I'm glad that question was asked so I could clarify that. You don't have to apply for deferment. However, with that said, you do want to make sure that your account are correctly in deferment so that it was reported correctly by your school, for example. So if you're in school and you're still getting bills for your federal student loans, then maybe there's something, where it wasn't done quite right to put you into deferment. So you might want to check in with the financial aid office about that. Now, that's for federal direct student loans only. If you have private loans, let's say you took out an undergraduate loan through MEFA, for example, you have to abide by the repayment terms for that loan. So let's say you did a deferred MEFA loan. It's only deferred for undergraduate school. So a lot of private loans, you can't defer those for graduate school. So you'd have to keep making payments on those. But that's a good question.
And then the one I want to give you a chance to address too for everybody, it's about loan forgiveness. Somebody wrote, so any loan is forgiven after 10 years?
You'd have to look at the different details on that. So it really it's federal loans, Plus loans can be forgiven, but it depends on the type of forgiveness. So I don't want to go through, we don't have time to go through every single one and, compare and contrast. So you'd have to do that research to check that out on the federal department website.
But this is, but these are only for federal loans, the forgiveness options.
Yes, only for federal loans. Now, with that said, if you do have a private loan, they may have, let's say, a death and permanent disability, forgiveness as well, or it might be, you might not have to pay it back. Let's say, for example, God forbid, mom and dad co-signed a loan for student passes away. If it's a MEFA loan, for example, we're going to, forgive that loan, obviously. So that there could be some types of death and permanent disability benefits for forgiveness for private loans too. But for the most part, when we're talking about forgiveness, we're really focused on those federal direct loans, including the plus loan.
And I think then there was a follow-up about what exactly the October 2022 deadline refers to. Forgiveness is certainly available. That, the option for federal loan forgiveness in general doesn't end there, but what does end at?
Right. Yeah, you have to go online and review that, because there's a laundry list of things we can't cover today. We have a webinar in May coming up that's going to go through that laundry list. It really literally is its own hour or two presentation. So you'd have to look at that. Even if you Googled it, you can find all the details of that. But we are going to cover that in that May presentation.
Okay, one more question, I think. Well, actually, we got a little bit of time. Sorry. Somebody said, my daughter will be walking in a ceremony, but won't be graduating until after she completes her summer internship. She'll be paying a full semester of college for these 12 credits. Will her loan start 6 months after her internship?
Yeah, it has nothing to do with the internship. It's after they graduate. So if she needs that internship to graduate, then it would be after she graduates. So it's after she graduates or leaves school. So if that internship is part of her curriculum, then that counts as quote unquote being in school. So it's after she graduates, it's 6 months after that. So not every student is going to be in that typical May graduation, start repayment in November. You could graduate in August after doing another class or internship in the summer. So it's 6 months after the student graduates or leaves school or drops below half-time status.
And then somebody wants to know, private loans. So you said private loans, say through MEFA, cannot be deferred.
It depends on what repayment option you chose. If you chose a deferred option, you can defer it. But after the student graduates, if you took an undergraduate loan out, then you would have to start making payments. And it's not just MEFA, it's any lender. You have to abide by the terms that you signed off on that promissory note of when the repayments will start. Okay, so do we have more here? So I see one there about if a student is planning to attend grad school, can they still apply for loans through MEFA? And the answer to that is yes, MEFA does have loans for graduate school. But we always recommend that students take out the federal direct student loans first before you do any private student loan borrowing. Then I see another question here about whether the loan servicer will contact the student about repayment. And the answer to that is yes, you should be getting emails or statements in the mail. But if the student is on the loan note, then it will be going to the student. So they do need to look at that. So unless the loan servicer has received information that the student is in deferment, they will send information to pay the bill.
Somebody just to address the question, I don't think we really have an answer, but somebody wanted to know the status of any sort of presidential repayment forgiveness. I don't think we really can speak to that at all.
No, we can't. Nobody really can because we don't, nothing's out, nothing's happened. There's no formal legislation on the table. The only thing we've heard is that the start date for repayment in May, based on the pandemic, loans will start to go into repayment in May, and we're hearing rumors, public rumors out there on the interwebs that that might get extended again. Loans were supposed to start payment in January. It was extended to May, and it might get extended again, but we don't really have any details of anything regarding, presidential or, legislative proposals to forgive student loans. And again, if anybody's looking for websites, it's all going to be on these slides that we're sending. So feel free to check those out. All right. Do we have any other questions? Let's leave it open for another few seconds. If anybody has any other questions, feel free to type those in. And we will definitely, send everybody a link to this recording and the slides to all these websites. I know it's a lot to take in, and I threw a lot at you today. It's a lot. So definitely, go online, use these websites, look at the detail based on your situation. And really the best place to go to for resources and help and questions is going to be the federal department's website or your loan servicer for a lot of this help that you'll need. Oh, so we have one question about doing a gap year. If students do a gap year, that does not count as in-school deferment. So they will be required to start repayment if they do a gap year. Okay, I don't see anything else coming in. Do you, Jonathan? I think we got everybody. Okay, excellent. Well, thank you, Jonathan, for helping me answer questions behind the scenes. And thank you everybody for coming. We should have a copy of the recording out to you either late this afternoon or on Monday through email. Okay. All right. Have a great weekend, everybody. And thank you so much for joining. Hope this is helpful, and be in touch. Our email and phone number is right here if you want to talk more and get a little more detail. Have a great day and have a good weekend. Thank you.